Let's face it, everyone wants to multiply their money. You would wish your $500 to become $1,000 the next day. Instead of being able to eat in a fast food chain, you'll have the chance to eat at a fine dining restaurant. Instead of commuting daily, you will have the opportunity to have your car. The power of having plenty of money is endless. More cash means reaching higher heights. An excellent way to earn money is by working, but just working alone won't cut it. That's where investing comes in. Investing can make you more money, like in the stock market. However, not everyone is very knowledgeable about the stock market. Don't worry, we are here to teach you a guide through the stock market, so watch till the end. You will start investing in no time. Welcome to Fund Rebel channel. Today, we will talk about money and finance, and if you're new to this channel, then hit the subscribe button below for more life hack content. How can you earn from the stock market? Let us start with something exciting. How can you earn money from stocks? There are two ways: when stock prices increase and compound. On average, stocks give at least 10% returns each year. That is why stocks are one of the most excellent investment choices. You may think, if I invest $1,000, I only get $100. That sounds awful. Well, it doesn't end there. Here is where compound interest comes in. They give a lot more than you expected. Investments are usually taxed, so the effect is your yearly returns will be much lower. So how can you avoid these hefty taxes? You invest in tax-deferred accounts. If you are sure you will not use your investment until you retire, that is a good thing to do. Tax-deferred accounts are accounts wherein you will pay tax only after withdrawing your money. An excellent example of this account is 401k, which is mainly set up in your workplace. Those yearly tax deductions will be allocated to your investment compound, thus maximizing its return capabilities. Imagine you are at the age of 30 years old. To be a millionaire at 60, you must invest at least $550 monthly at 10% annual compound interest. Compare that to just putting it in the bank, which will only have you end at $198,000. The difference is so big, right? How long does investing in the stock market take? If you're thinking about investing for just days or months, do not invest in the stock market. Investing in the stock market takes years and even decades to have any great returns. You will not have any good returns when you trade for days, weeks, or months worth of time. When you decide to invest in the stock market, make sure that the money you're putting in will be in there for a long time and that you will not pull it out anytime soon. Stocks have their fair share of dips. When the pandemic started, S&P 500 crashed by 30%. The stock market is very volatile, so be prepared for the worst. On a positive note, stocks have surpassed the growth of other investments like bonds. You cannot tell how stocks perform in the short term. How would you know what is the best stock to invest in? When investing in the stock market, you should have guts, mind, and soul. Everything. You should be able to withstand every crash and growth of the market. Make your mind do the work, not your emotions. Now, how would you know the best stock to invest in? There are two ways: belief and knowledge. Investing requires a strong sense of action. Investing is a one-person team. You get to decide for yourself only. Start investing in things that you believe in. For example, you love technology. Then start investing in Tesla or Apple. You're very knowledgeable about these things, so they are the ones who will work for you best. You believe and you know that these companies you have faith in will reach new heights and be more successful. Now, to strengthen that faith and belief, it should be backed by facts. Researching is a must. Doing simple research only takes a few minutes or hours a week. Find and ask questions about the company and its work. How does Apple continue to sell many phones? What are the things that are unique with their devices? Or for Tesla, what are the environmental effects of their cars? And how can they help reduce the cost of fuel? Asking and knowing the answers to these questions will help you understand what the future of the company is and if there is room for growth. You don't need to invest in every stock you find interesting. You just need to invest in the stocks you know inside out. Take note of the quote, quality over quantity. The reason for stock market crashes. The stock market has crashed many times over time. The 1929 crash, the Asian financial crisis, the 2008 dot-com bubble, and the most recent, the 2020 COVID-19 pandemic. And this not only affected the US, but the whole world. Stock market crashes are driven by outside problems related to them. One problem can cause another problem that becomes a domino effect. Panic and selling pressure are the leading causes of stock market crashes. Now, it doesn't end there. Companies that manage these stocks are responsible as well. When a company does poorly, the stocks fall. When the company does great, the stock goes up. That is why companies must be pressured to perform well because it directly affects their stocks. You may ask, what should you do when stocks crash? Do you panic? Do you sell? Certainly not. Stock market crashes are like a big time sale. Buying a stock 25% or 30% lower than its original price is a deal. Remember, start being greedy when others are scared. Classify your stocks. Not all stocks are the same. Some may perform well and some may do badly. All of them have their different paces of movement or progress. On one stock, you may do 70% easy return, while on the other, you are already losing 50%. However, it is not just about the ups and downs. There are different ways you can classify your stocks. Note that their categories may change over time or may stay the same. Some companies may even be in 2 or more types. So what are these categories you can classify your stocks in? Number 1. Fast growers. They are mostly known to be starting companies. You don't need to worry if you start investing in it 1 to 3 years later. They have a lot of time to grow. They are known to increase at least 20 to 25% per year. They are fast-growing companies or industries. Another reason is that they are excelling amongst lower competitors. Fast growth means high income revenues, but you still need to check the company's balances and deficits. Number 2. Slow growers. Slow growers only grow 3 to 15% each year. The good thing about them is that they have steady growth. So, slow growers are not necessarily bad at all. They tend to keep a slow yet stable growth. They are still good options. Number 3. Cyclical companies depend on the growth and how well the economy is doing. For example, if the US economy is in recession, they also go down. If the economy is doing good, they also go up. Companies that can be categorized here are car and housing companies. Make sure that the company is in decent shape even at the lowest point of the economy. That is the best time to invest in them. 4. Turnarounds. These companies are in bad shape or have low worth, but they have a chance of reversing their current situation. You believe they can make it to the other side of the coin. Make sure that you check their balance sheets. Check if this company can fund more projects or can survive for a few more years. They are inclined to improve themselves. If you see that, start to bet. Number 5. Asset play. They use other strengths they have to build and grow their company. Things like branding, lands, and other ventures. They are the assets that do not show on the company's balance sheet, just like its branding. Why do people buy luxury items like Louis Vuitton, Chanel, or Hermes? Because they're popular and the brand is their strength, not because they produce something innovative or new. How do you know if a company will do great in the future? The company may have been doing good before and now, but there's no assurance that the company will do good in the future. However, it can be estimated. Things like sales, production, innovations, and so much more. What is the company's roadmap, and what actions are being taken to make this growth happen? An excellent way to know if the company is doing well is its price-to-earning ratio, or P/E. For example, their share price is $200 and they earn $10 per share. Then the P/E ratio is 20. It can be considered an indicator of how many years the company can earn back your investment. It can help you decide if the company's stock is too pricey for its earning capabilities. Lower P/E means cheap stocks, while high P/E is price stocks. Compare the P/E to its growth rate. Low P/E but high growth rate indicator. You can compare the current P/E and the past P/E of the companies to determine how well they are doing. How dividends play their part. Dividends are amounts paid by the company to its shareholders from its profits. They have a choice to pay it out to investors or to reinvest it in the company. Reinvesting it in the company will help it expand and probably pay out more dividends in the future. An increase in yearly dividends can be a good sign that a company is doing well. But don't always be fooled. Not all the time, companies that pay out high dividends are doing well. Imagine you are receiving a $20 dividend from a $200 stock, yet they are only earning $22 per stock. All their earnings are going to dividends. It is done to fool investors into investing more. It is better to check the company's balances. Manage your risk. Make sure that you know how to manage your risk. So, how to see if you are investing in a low risk company? Research about them. Know how well they are doing. Do they have a solid business plan? Is the company backed and promising? The most profits will come from starting companies as they have a lot of room for growth. Always find the best buying opportunity. Use the P over E ratio if the stocks of that company crashed, yet they still have a solid foundation, or the company's stock price crashed, yet the growth rate is in an upward trend. Then it is an excellent reason to buy from them. The better the foundation, the lower the risk. The point here is to learn everything about the company, every single detail of it from head to toe. You will then know what is the right action to take. Again, this is Fun Rebel. Thanks for watching. If you like this video, please click the like button. And if you want to upgrade your life from what you have to what you deserve, click the subscribe button now.